Hey guys, Chad Larson with MLD Wealth. It's another episode of MLD Money Matters. It's September. Um, Aside from being the long weekend, and so it's the fifth day of the month here as I'm filming and recording this, it kind of seems like January 1st. Kids are back in school. Everyone's put the summer toys away, so to speak, for rightfully so. But as we embark, and since I've been a young kid, it always seems like September is the start of the year. New intentions are set, largely, especially people in North America spend a big chunk of the summer enjoying the short seasons of good weather that we have. But it feels like a new year. The leaves are starting to turn, and we kind of get back and dust off our boots, so to speak, and take a stock of things. I struggled over the weekend when I really thought about what I was going to discuss today, and I don't have really a set presentation or deck to go through, not because I'm ill prepared, but because I think I'm sensing fatigue in the marketplace, fatigue from private clients, fatigue from trading counterparties, investment bankers, etc. I've been through this before many times, and unfortunately, it's how markets are. There will be more times like this, but I kind of take stock, and I watched and reviewed a bunch of our past recordings, and I don't want to say they're not negative, but they highlight some obvious things that are going on in the marketplace. And our job as wealth advisors, as my job as a portfolio manager, is to position capital based on clients' individual needs, goals, liquidity requirements, and expectations to meet those over a market cycle, or build them to have the highest probability of achieving them. Now, I went through a really unique, it's not experiment, but an academic exercise over the last month or so. I've alluded to this in the past, and I apologize. It's been jammed up just now. It's well past legal and compliance, but it's in with marketing right now. But I've alluded to a first of its kind partnership in Canada that MLD is undertaken to really bridge the gap between retail wealth management and institutional level portfolio management. So that's been done, and we're excited to announce the branding of it and introduce it to all of you. And when I say bridge the gap, I spend a significant amount of my time in Toronto and meeting with family offices and endowments, etc. And there's always this gap that exists between retail wealth advisory and institutional asset allocators. And there's two things. Well, they're each missing one thing. Generally, one is they've if it's an institutional asset allocator or manager, they miss the softer issues. They generally don't do well connecting with the families, understanding the intricacies. Much like when we're looking, at a stock, I always said managing capital is very easy on its own. Managing capital, once you mix it with people, it's a whole different ball game. The same type of variables that go into a stock price's return, aside from the short oscillations of things like fear and greed, and the shorter term kind of economic results, quarterly results of a company, paired that with the long cycles of economic cycles within a family unit. There's all sorts of things. There's the bad D's. There's the death, the disaster, divorce. There's health issues that come up. There's issues with kids. There's liquidity pockets that come up. Generally, never when people need them. But trying to pair both of those things together is, I guess, why I have a job, and I love what I do. But that gap in between what they don't do well and maybe what retail wealth management doesn't do well. But it's I get that question all the time. They're like, Chad, I know you guys are managing my capital, but you're out for lunch, or you're on a holiday, or you're traveling. Like, who's looking after things? I think when you really look under the hood, and we've done a much better job of not so much in the disclosure and transparency, but in the communication of how we choose to allocate our capital. I don't purport to be the best Canadian equity manager, the best U.S. equity manager, the best global equities manager, the best fixed income manager, and we're smart enough to know what we don't know. And based on the size of the amount of capital that my team manages on behalf of private clients, we're able to negotiate direct drive, pricing efficiencies, direct access to some of the world's leading asset managers. And so within doing that, when you look under the hood and you slice the onion, it's not Chad Larson and it's not just MLD, it's not just one singular person, but we with scale employ a strategy that calls to action some leading institutions across the globe that are working around the clock tirelessly, supported by their chief investment officers, their chief economists, and it all comes together in a symphony whereby we feel very convicted that we have created a model platform whereby we feel very comfortable allocating our client and our own capital to a material degree. But in doing that, bridging those things, is it just become a synopsis or scenario whereby it's greater fool's theory, or there's biases that exist? What are the things that institutions have and employ in a disciplined fashion? Is a formalized investment process. There's risk selection, there's investment process committees, there's liquidity analysis, there's a whole another substrate of tests and hurdles that go into constructing a singular portfolio. We took a step back and thought, no one's done that at the retail level. No one is really up their game. And so I was excited to do that. It's taken almost 7 months to get through trying to marrying the two worlds together. But very happy to announce we are up and running. You'll see more of the visuals on it and kind of the rollout of what it is. But we have partnered with a leading institution as a formalized partnership to bridge that gap. We now have a lateral extension, a second engine that is powering our analytics, our capabilities, and working to provide insights both from analysis, risk analysis, but on performance reporting, attribution, understanding what is driving returns and what our sensitivities are. I look back over the last year and a bit, and we've been preaching all of last year, and this is a tough year. Listen, I went through this, I want to say it was 2013, where you come out of a bad market, markets start taking off, and we'll speak to that, and yet there's this bit of a lag effect because you're kind of toehold and hamstrung to some alphabets or small cap positions that are still being worked out. They're still on their knees, so to speak, waiting to come back as liquidity improves and capital markets start to thaw. But we had it compounded this year. Again, I'm very respectful of the fact that relative performance doesn't pay the bills, and investors largely in North America are fatigued because last year a balanced investor, the benchmark across North America, was minus 18%. Dismal. We did far better than that, significantly, but being better than the worst or better than most, generally still in a year like last year doesn't advance it. But I kind of made a lot of analogies over the last couple of years about the golf analogy. It's like, okay, we're on the side of the fairway, barely in the shortcut, still have clear line of sight, and confidence to be able to not have to carry a terrible water hazard or a trap to get to the green. Whereas if you were an index investor, it would have been tough off. And then this kind of analogy kind of got thrown back in my face. So, you look at the NASDAQ this year. I'm not going to go, no one holds me to account on basis points of detail here, but, a small subsect of the economy has driven the market, like things like Nvidia, Facebook, Amazon, et cetera, bifurcated and had outliers. Like outliers are just that, they're outliers. You strip off some of the, tech darlings and AI proponents of the marketplace. You look at the Canadian banks in general, the Canadian banks, have been very tough. We have never seen again, we have a scenario where growth stocks traded a premium above value stocks, more expensive than we saw in the new economy.com bubble of 2000. So comparing ourselves to indexes is a futile exercise, especially for largely our clients who we consider, and we've kind of created the acronym, live a work optional lifestyle, or strive to have a work optional lifestyle. It's maybe a cooler way to say retired, but clients that have come to us and look to position their capital and achieve lower volatility and earn their share of market returns given their individual risk tolerances and liquidity requirements, how much of a portfolio is directly invested in the NASDAQ, which is dominated by non-profitable, high-growth technology companies. Very little, enough where we are getting positive attributions, but we have to be cautious. I think within that, some of the things that we were going to talk about, I wanted to talk about more, on this partnership, and so what it is we want to be able to, retail advisory books, the amount of capital that we manage in the industry as a whole, not specific to MLD. They're growing. The cream has risen to the top, and I do believe this is a self-policing business. And so you don't want to rest on your laurels. And I think I said this to my son the other day, and I maybe it's like ripped off from The Social Network or something like that, and the movie about Mark Zuckerberg. But solving many people's problems for an economic return can make you very wealthy. The more problems you solve, or the larger problems you can solve. Generally, there's an exchange of economics in there, but with the concentration of wealth that our clients have. And just remember, I do get this comment a lot of times, some of the benefits, and here I'm going to go on a tangent a little bit. What COVID did was largely change a lot of the way that clients feel comfortable and or want to engage with us, largely over video or in print or et cetera. They're all living their lives in their own, whatever it means, their best life for them, whether they're actively employed and working hard, whether they have a young family, whether they've got grandkids, whether they're pursuing their own interests, but, they hire us to do a certain job. And, the time is not what they buy from us, and it's in the value of the advice. And capital is very scalable. Everyone asks, and I don't want to be contrived about that. I'm a big enough client for you, or am I too small of a client, or am I too big of a client? There's a sweet spot, and I have to say we have a phenomenal group of clients, and they're all equally important to all of us, and they are all treated pari passu and across the board. How we choose to engage with them has just changed over the years, and I think that the old school brokerage model of feeling like there's value because you're getting a call once a week, once a month, once a quarter, just to kind of shoot the breeze, so to speak, and talk about the weather. I think the really intelligent answer is that is, we're looking for advice and value, and we're working tirelessly. There's a large team that is supporting us in running analytics, looking at scenarios, looking at attribution, constantly looking at and circling back as what are the things we would look to improve, develop, or change, whether it be in our own personal lives, our professional lives, in our investment processes, et cetera. And when my partners and I sat back a number of months ago and said, listen, we manage a lot of capital. With great power comes great responsibility. And what are we doing to enhance that? What are we doing to ensure or increase the probability of success of the capital that we manage on behalf of our clients? And that got us down the path to find an incredible independent partnership that we're funding the economics for out of our own pocket to add value. So, excited about that. Things that I can tell you that happened along, with the economy. Same thing, at an economic level or at a market level, we continue to see joblessness kind of creep up. Housing prices have shown an incredible amount of resilience, obviously some softening in select parts of the market. But I think what I wanted to do was set the table a little bit. And so, 14 minutes in, I don't know what I've said other than saying some concepts at a high level, but I want to take away, and if you could close your eyes and sit there for a minute, you take back all the news clippings you're hearing about, in an NVIDIA or a Tesla or you name it, or how one thing is doing, and you take off all the distractions, good and bad. What do we have? Where is our capital invested? Capital is invested predominantly in public companies, but across gamuts of industries, sectors, geographies, styles. But ultimately, it's invested in the economy. And what is the economy doing right now? We have record high inflation. It's coming down and cooling, okay? But just remember, it's not going the other way. So cost of living has increased. The other thing we have is some of the highest interest rates we've seen in many, many, many years. So the affordability of people to borrow money to invest in themselves or invest in new businesses or new products and new services has been hampered. So companies aren't hiring as much, companies aren't producing as much, people aren't buying as much. We have a contractionary environment. So if you just had to use a crayon, the economy's not great. Well, I don't think it takes a rocket scientist to see through that and say, that probably means the market's not doing wonderful either. And that probably means my capital isn't growing the way it is. Yes, year to date, there's some positive growth and things get too cheap and then they start to recover. And we're trying to ebb and flow, lean in, tilt away, and deploy capital in the shorter term at the most effective time to counteract some of the obvious cyclicality that we're seeing. So we're going through a recovery phase right now. More and more we're seeing, again, some commentary this morning. I think it was JP Morgan. Don't quote me on that. And again, this is all pretty from the hip. I wanted to be as authentic and real as possible. Reducing the probability and the forecasts that the economy slips into a recession. This soft landing everyone's been talking about, and the market's rallying a bit on that. We've seen oil prices start to rally. Like, oil hurt us. We had overweight exposition to oil last year and avoided a lot of the tech disasters. And so that, staved off some of the benchmark or broad market pain that many investors felt. But with conviction, we maintain those positions, and year to date, they've hurt us. We outperformed last year and we're underperforming the benchmark this year. And then in the last 90 days, not even sort of the last 30 days, we've seen an incredible move to commodity prices, and oil stocks have woken up. So, jumping ship and changing convictions day by day, night by night is quite frankly, it's luck. I think we pragmatically look at our capital markets outlooks based on consumption patterns, demography, geography, economic cycles, and say, where are we best positioned? Where is our capital best positioned? And remember, there's no one answer, because no one invests in one thing. So to be naive and say, well, and I keep saying NVIDIA, maybe I'll just title this thing NVIDIA. We should have put all our money in the NASDAQ this year. No one's going to do that. We have to be rational. We have to be prudent. We have to be properly diversified. If someone was perfect enough to say I was 100% oil stocks last year, and, at the end of September last year, we sold all our energy stocks, waited 4 months, and then plowed everything into the NASDAQ. Well, wow, you wouldn't be the smartest person. You'd be the luckiest. But where are we positioned now, and do we continue to have conviction? I think that's one of the other questions that people come to me is all the time, saying, are you still convicted in your positioning strategies? And I think the answer is yes. We're seeing, underinvestment in the supply of energy. We're seeing the electrification trends continue. We're seeing consumptive trends and the search for deep value across great old world businesses that have incredible balance sheet. And we're going to stay along that path. Did reduce some of the exposures to gold. I know we're going to enter into a really unique year. I can't wait for the January outlook this year, because we'll be on the front end of an electoral race, which will always drive markets. If any of you remember, our market call during kind of the end of 2019 into the first Trump presidency, when Hillary Clinton was leading the polls, the play was avoid healthcare. And that didn't last very long. And when Trump started surprising polls and looked like it was, he was going to, shock the market, it was run to gold, because no one knew, what this crazy orange man was going to do. And the minute he got elected and he said, we're going to make America great again, all you had to do was just go all in on the S&P, kind of like Reaganomics, and just buy that. So, I'll leave my politics aside. I think there'll be, I do think there'll be a regime shift on the other side. Watching John F. Kennedy as well. I think he's a very interesting candidate. Maybe next time or into the next quarter, I'll do a segment on U.S. politics and how that goes into shaping some of our outlook. Aside from what our viewpoint of it, because I'll tell you, politics drives policy, policy drives economies, and so if you're not paying attention to politics, it's my job to, and I actually quite enjoy it. Some of the questions that kind of hit my desk was, if there's a recession on the horizon, why not go to more of a cash weighting and earn 5%, well, more now, and wait? Well, because when the markets do turn, I think that we've already seen some recovery and resurgence into that. Markets year to date are positive, and they're outstripping those returns of cash. We still are carrying an elevated weighting of cash because we want to be selective, and we're still uncomfortable with. We reduced our exposure to the Nasdaq in August, a little early. We rode some of that wave, but this is one of the first time a risk-free rate of return has been high enough that it's not killing us by any stretch of the means. And remember, the golden rule is not what they taught you in Bible studies. It's not do unto others as you would do unto yourselves, but it's actually he who has the gold makes the rules. So having liquidity is always important. So that's a good way. If you're seeing cash, it's not because we're bored. It's not because we're not paying attention, but cash is tactical. Asked if I could address the Canadian dollar and what we think of debt levels that Canadians are currently carrying. It's a little bit of canary in the coal mine. The largest primary source of wealth for Canadians is their homes. We've seen incredible robust appreciation, not so much maybe in select geographies, but across the housing affordability is driving the tape at the Canadian side. The Liberal government has done a horrible job at managing that for a myriad of reasons, on approvals, on permitting, but also, we have a wide open immigration policy. And so you just have a scenario where you've got rising interest rates, mortgage affordability has gone in the tanks, and yet we're setting record home prices. There's literally too many people for houses. So you have a scenario where you have way too much demand and not enough supply. And so, but the debt levels that Canadians are carrying is significant. You're going to see more of this roost out. I kind of called for it later in the fall. You're going to see more joblessness. You're going to see more people react to unattainable levels of consumer debt, and it'll be unfortunate, but that Canadians are carrying a lot of debt. Interest rates, where are they going from here? Where are we seeing opportunities when it comes to fixed income, and what are you doing to take advantage of it? Our exposure right now to high yield markets and to private credit, as many of you are well aware, alternative assets make a big component of our thesis for our accredited investors, and the not resurgence, but call it the more mainstream adoption or comfortability that Canadians have, and the more available opportunities for Canadians to invest in private credit has been a boon. It's been a great place where we've had incredible amount of success, like with our partners at SAF. What are we doing about fixed income? I ran an analysis on our, the breadth of our model portfolios this month through this partnership I've alluded to. Our exposures right now, and it's interesting when you model them backwards, we had very little exposure. When interest rates were rising, we were not getting crushed. So we had very low sensitivity to interest rates. At some point, and probably near into the future, I know in the US people are talking about higher for longer, and I've made the discussion over the last couple of months that we have added duration, and we have looked to pull at some of the long ends of the curve, because eventually interest rates will come down and there will be equity-like returns in the fixed income market. So yes, we have exposure to high yield credit. We have exposure to private credit. Within the bond market, we're seeking out some duration to try to term some of that out, but also to get to that leverage effect when interest rates start to moderate and come down. But I don't think they come down. If they came down in Canada, it's because people are bleeding on the street, so to speak, because the market's in a tailspin, so to speak, at the consumer level. They're not there yet, and as we know, governments typically react way too late and with way too little. So the rates, I think, are going to stay higher for longer. And so, we'll take advantage of that where we can. But just remember, that's also impacting companies' profitability and companies' abilities to raise capital. So it's 6 of one, half a dozen of the other. one of the biggest concerns, another question that was lobbed in, was the biggest concern is how long can periods of going nowhere with returns go? Addressing this concept of, not concept, there's a reality of client fatigue. Like, I will tell you, I take the emotional indicators along with the economic indicators, and my phone doesn't ring off the hook, but I'm acutely aware. And most of you know me very personally. I'm a very sensitive person. The amount of not negativity is not the right word. I guess fatigue is the right word, and it's not irritability. It's, we're looking at, financial plans and expectations, and we all map them out, whether they be quarterly, annually, semi-annually, to see how we're doing along track. You go through these periods of nowhere performance. It's disheartening. But just remember, an economic cycle, and its average is 7 years. And, family index numbers, something you're all very familiar that we discuss about. We don't look at benchmark indexes. We look at that number that a client needs to achieve over a market cycle to meet their goals long term, whether it's to achieve a work optional lifestyle or to fund their work optional lifestyle. So you go through these periods, it really causes self-doubt, it causes fatigue, it causes angst, and causes people to make the wrong decisions. I think the last thing, and I will never forget this, I can never say who they are, but I remember one investor many years ago, and it was after like the tech stocks ran like crazy. He called me, he says, I should have just put all my money in Amazon or Google or whatever it was. And the guy did. And it was literally at the exact top of the market, because he was tired of getting, mid to single digit and low rates of return. The market value stocks had been under pressure. But I will tell you, you can make years worth of performance in a year or in a quarter. And so staying with the plan, staying invested, always think about, it's about the people, the process, and the philosophy, and how that capital is positioned. And do we answer the question within review is, are we prudently diversified? Are the people capable? Do they have the risk controls, the track record, the economic foresight, the abilities to navigate these things? And if they have all of those things, it makes sense, and you just continue on. But listen, no one is enjoying this, including myself. A couple other questions, and I'm spitballing, maybe we'll make a segment of these two, and I'll open up a mechanism just to lob questions in from the audience of clients that find this useful. But if I have a 5-year or longer time frame for needing funds for my investments, what do you do with new cash right now? Keep in short-term money market or invest? 5 years is a very long time. Now, you need money within a year. Generally, I don't recommend equities. 2 years, even as such. I would say off the back end of what we've seen as a corrective phase in a down market, that tolerance or risk I would take of shortening those, being able to tolerate some equity risk, is shorter than I generally would, if that makes sense. 5 years is a long time. I would hazard to say, yes, there are 5-year periods in the marketplace. You go look through some of the 80s, and 90s even, there's periods where the indexes are completely sideways for upwards of a decade. That being said, there is the participation of dividends, and we try to, aside from an entire index, but look at the subsector and see where we can find performance. So 5 years or longer, because rates will come down. Your simple interest, it's incredibly tax efficient. You're not going to get 5% for 5 years. If you're looking at bonds, in that range, great, but you're giving up half your money to the government in taxes. So I would look to feather, if it's a certain portion of your portfolio, and you're going to need some, work with your advisors, and I'm talking this more broadly, but talk to any member of the MLD team such that we have pure visibility on those liquidities, so that we can build them into the cash flow assumptions, the liquidity expectations of the overall portfolio. I'm never concerned, if someone wants 5% of their portfolio in cash, call me tomorrow. If you want 100% of your portfolio in cash, probably that, you should have let us know, or, and I apologize if some disaster or unique event happened within your, family unit that you require, that amount of liquidity at one time. But it depends. I guess the right answer is depends on what that money makes up as a percentage of your liquid investments. What part of the market do you expect to recover first? How are you or the institutional managers you work with investing in my portfolio right now? Listen, with, I will say in a two-part way, both with the implementation of our partnership with Envestnet, our reporting capabilities and transparency that we've employed. As many of you seen, we've largely gone away from some of the more albeit accounting efficient, tax efficient funds, but have gone largely into select security portfolios. You can see at any time, what it is you're owning and buying. And I did produce last quarter a trade rationale, which I'm very excited to produce on a quarterly basis, and it'll let you know quarter by quarter what we're buying, what we're selling, and why. And I think that mea culpa on me. Listen, I don't know or knew, but I'm well aware. I'm an investor as well. I want to know what's going on. And so I've just been delayed. First it was, legal. How do we enter into this kind of investment selection, pseudo risk management arrangement whereby, the institution doesn't carry any liability, but provides, a deep amount of insight, analytics and reporting for us. So I have it all now. And listen, maybe the best thing I can do is say it out publicly is you all have it by the end of the month. And I'm very excited. I think it hasn't been done in Canada yet, but the transparency, the insights, the look through, and the engagement, I expect to be greatly improved. Have there been any positioning changes this year, and what specifically have those been? I think that positioning is a large word. We've made a lot of trades tactically, strategically. We've talked things about adding duration to long-term treasuries, long-term U.S. treasuries. We talked about some inclusion of the yen currency. One of the questions dovetailed into this was our thoughts on currency. The U.S. dollar is strong right now. I think the dollar basket should weaken. But with the U.S. kind of looking like they're going to avoid a recession, the dollar basket's going to continue to surge, which, is if we had a better energy policy, we would have a big run on the Canadian dollar to the positive, which I know for Canadian investors is, when they talk currency, they really talk about one thing. They want to talk about their competitiveness largely to the US dollar, because many of them spend winters and have a lot of connectivity. The US is our largest trade partner. It's also our largest, we share the largest land border. And we spend a lot of time there as Canadians. So aside from a smaller subsect that are more sensitive to things like the euro, the franc, and the pound, I'll talk on that. But I think the US dollar basket is a little expensive here, so it makes me nervous. It's going to be one of those years that a lot of the return could be muted in a real effective dollar term. Long, confusing way of saying, if that happens, that means actually something good is happening in Canada, so I'll take it. So if I have to give up some on the US dollar, it means like all of our other stuff is really working. So the positioning, we are increasing our exposure to the Canadian banks down here, largely as a basket approach. Looking at things like writing covered calls on the Canadian banks, or an exposure just as a broad basket. You generally see after such turns or volatility measurements in banks, the banks will do very well. Working on a lot of exciting things in the background, hopefully that will come to fruition through the fall. But I've been verbose here, as I always am. We're into 30 minutes, probably all tiring. I've probably done a great job of putting many of you to sleep, but I understand a lot of the concerns that are coming in, and I appreciate all the positive feedback. I'm just so blessed to have such amazing, client families. I know many of you personally, and look forward to getting to know many of you more. My door is always open. My phone is always answered. Any member of MLD here is here at any time that you need to answer any questions, or if you have any concerns. I just want to thank all of you. Have a wonderful September, and we'll be chatting soon. Take care.